Hi everyone, welcome back to your free accounting and management accounting class. Today I am going to discuss about the difference between absorption costing and marginal costing through an example. In fact, I made a video on this. So what you can do is I will put the link below. You can go through the lectures on absorption and marginal costing principles, and however I will recap some of the principles which I discussed in my previous video before start discussing this particular example. Okay, so let's move on to the question. Before that, let me explain you about the difference between absorption costing and marginal costing. So what is the main difference? Main difference is under absorption costing, the total production cost is valued at full cost. What does it mean? It means you need to take into account variable production cost as well as fixed production cost. Okay, so under absorption costing, your full cost consists of variable production cost and fixed production cost. So that will be your total cost. However, under marginal costing, your production cost is valued at variable production cost. So that includes only variable cost. And fixed cost are treated as period cost, and it is deducted in the profit and loss account. However, under absorption costing, there will be over and under absorption of fixed cost. So these principles you can go through my previous video in order to understand the over and under absorption fixed cost. How do you make an adjustments to the income statement? Okay, now let's move on to the question. So let's go through the question first. XYZ company manufactures toys. The data related to 1 unit of toy set is as follows. Selling price per unit is 14. Direct material per unit is 2. Direct labor per unit 3. Variable factory overhead is $1.4, and you are given fixed factory overheads 92,000 per year, and budgeted production capacity is 20,000. So the production capacity is 20,000. The production and sales units for the last 3 years are as follows. So you are given 3 years, 2008, 2009 and 2010. So 3 years production and sales capacities are given. So 2008 the production is 20,000, and also sales quantities are 20,000. 2009 produced 18,000 units, however sold 15,000 units. 2010 10 produced 21,000 and sold 21,600. So these are the basic information you are given. Okay, so what are the requirements? There are no selling and distribution overheads. Okay, so you have only fixed factory overheads. You are required to prepare the income statement under absorption costing approach for 3 years, and second, prepare the income statement under marginal costing approach for 3 years. Then explain with supporting calculation the difference between profit reported under two approaches in 3 years. So you need to show the difference. So there will be a difference between absorption costing profit and marginal costing profit because of the treatment we apply in calculating the production overhead cost and the closing stock. So please remember, under absorption costing we use the full cost, whereas under marginal costing we use the variable production cost. Okay, so therefore in valuing the production overhead cost and closing stock, so there will be a difference. So let's identify how we're gonna calculate this. Okay, first of all we'll move on to the absorption costing approach for 3 years. Okay, so what you can do is, first of all you need to take the selling price per unit. Okay, so selling price per unit is 14. How much has been sold in 2008? 20,000. Okay, so 20,000 times 14, how much is that? 280,000. So this is the sales amount. From that you need to deduct the cost of production. So cost of production or cost of goods sold, how do you calculate cost of goods sold? So it is the opening stock plus the production less the closing stock. So thereby you can arrive at your cost of goods sold, cost of sales. Now as per this question, there are no opening stocks. In 2008 you are not given any opening stock. The production is 20,000 and sales units are also 20,000. So therefore the opening stock will be 0. There is no value. Now production. So how do you value the production? Okay, so as I explained you earlier, under absorption cost you need to take the full cost, which means your direct material cost, direct labor and variable factory, all these are variable cost components. Okay, so all these three costs will have to be taken first, which is $2, $3 and $1.4. So when you take direct material, direct labor and variable production overhead, okay, so that total is 6.4. However, you need to include another cost, which is the fixed production overhead cost. How much is the fixed production overhead cost? And how do you calculate that? So now you are given the fixed factory overhead cost as 92,000. Okay, so 92,000 is given. How much is your budgeted production capacity? 20,000. So simply you divide 92,000, your cost 92,000 divided by 20,000. How much is that? 4.6. So fixed production overhead cost will be 4.6. Okay, so then what will be your full production cost? 11. Now you calculate your production cost. Per unit cost is 11. How much has been produced? The production is also 20,000. Can you 20,000? Okay, so 20,000. Then what is your total production cost, which is 20,000? You understand? So 220,000, which is 20,000 times 11. Okay, so this is 20,000 times 11 will be 220,000. Okay, so what is your closing stock? There are no closing stocks because whatever the production, the entire amount has been sold. 20,000 has been sold. So therefore there is no closing stock. So the closing stock will be 0. Therefore opening stock plus production minus closing stock will be your cost of sales. Cost of sales is how much? 220,000. And are there any over under absorption here? There are no over under absorption because the production capacity is 20,000. Okay, so production capacity is 20,000. The company has produced 20,000. So therefore the full cost has been absorbed under production overhead cost. Okay, so since 20,000 production capacity and produced also 20,000, okay, the full production overhead cost has been absorbed here in the production overhead cost. So therefore there is no over under absorption. So simply deduct the cost of sales from sales, so which will be 60,000. So in 2008 your net profit will be 60,000. Now let's quickly move on to the 2009 figures. Your sales units 15,000 units. Your selling price is 14. So when you multiply 15,000 times 14 will be 210,000. Okay, then your production quantity will be 18,000. So 18,000 has to be valued at full cost, which is 11 per unit. So which will be 198,000. So there is no opening stock because in 2008 we produced 20,000 and we sold 20,000. So there is no opening stock. However, here in 2009 produced 18,000, sold 15,000. So therefore there is a closing stock of 3,000 units. So that 3,000 unit has to be calculated at full cost. What is full cost? 3,000 units times full cost 11. So which will be 33,000. And your cost of sales will be 198,000 minus 33,000. So which will be 165,000. So what will be your gross profit, which will be 45,000. 210,000 minus 165,000, 45,000. Now there is one more adjustments to be made here, over under absorption. There is over under absorption. Why? Your budgeted production is 20,000. However, however, you produced only 18,000. Okay, so therefore the full production overhead cost has not been absorbed fully. Okay, so 20,000 is your production capacity, whereas you produce only 18,000. So how do you calculate that? Okay, so the production is 20,000 and actual production is 18,000. So what is the difference? Difference is under absorption of 2,000 units, okay, times what is the fixed production overhead absorption rate, which is 4.6. So 2,000 times 4.6 will be 9,200 under absorb. Okay, so since it is under absorbed, you need to minus it. Okay, so which means from the profit, since the cost has been under absorbed, you need to deduct it. Okay, so which will be 9,200. The fixed production overhead cost has not been fully absorbed to the production overhead cost, so therefore there is under absorption. So you need to deduct it from your profit, gross profit, to arrive at your net profit 35,800. Is that clear? Okay, now let's move on to 2010. 2010, how much is the sales? 21,600. 21,600 into 14, again selling price 302,400. And what is your opening stock? 2009 there was a closing stock, so that will be your opening stock, which is 33,000. We already calculated 3,000 times the full cost, 11 per unit. How much is the production? Now you produce 21,000. Though your production capacity is 20,000, you produce 21,000. So 21,000 at full cost, which will be 231,000. So which is 21,000 times 11 will be 231,000. And there again there is a closing stock adjustments to be made, because you had 3,000, you produced 3,000 opening stock, you produced 21,000, so total stocks 4,000, and you sold 21,600. So therefore your closing stock amount is 2,400. Is that correct? Yes, 2,400. This has to be valued at 11. So how much is that? If you value at 11, which will be 26,400. Now calculate the cost of sales, opening stocks plus production minus closing stock, 237,600. Now they are again, you need to make this O1 absorption. Remember, we absorb our fixed production overhead based on budgeted production of 20,000. However, our actual production is 21,000. So overproduction is 1,000. So therefore, we have over absorbed into the production cost 1,000 times fixed production overhead. Absorption rate is 4.6, 4,600. So therefore, that has to be removed from the profitability. So which will be 233,000. So 237, I'll make this adjustment, 302 minus 237,600, which will be 64,800, your gross profit. To that you need to add 64,800 plus 4,600, your profit will be 69,400. So this is the calculation, 69,400 under absorption costing in 2010. Okay, so now we have completed the first part, which is to prepare the income statement under absorption costing method approach. That part is completed. For 3 years we calculated the net profit. Now let's move on to the second part, which is marginal costing approach.